Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for July 5th, 2021. Please see our disclaimer for important information. Well, as we get started in the week following July 4th, hope all of you had a good long weekend with family and friends and celebrated our Independence Day. As we look at the data, begin to get into things here this week, I think by and large everything continues to track fairly well. We've had a little bit of fits and starts on some categories as of the last week. The longer term trends continue to be pretty solid. Rail car traffic's off a little bit, perhaps some seasonal variations there. But some of the short-term indicators, as witnessed here in the high-frequency data table, hotel occupancy has been fairly strong. Interesting data point on the restaurant industry, that number being down a little bit over the last week, but it's been fairly solid for quite some time. And over the last month, up 2.7 TSA checkpoint data. We had a lot of travelers. I know that the load factors are probably closer to 90% now. So we continue to see a lot of great traction in mobility, and then motor gasoline demand continues to remain fairly strong. A lot of people on the road this weekend, and then the increase in global commercial flights very strong as well. Well, I promised several weeks ago that I would break out the COVID-related information into a separate presentation, perhaps, but the trends have been fairly monotonous, fairly boring, in fact, and really the day there's really nothing new and dynamic in the data. However, I thought I'd just go ahead and give you a quick update here, just because we have more rhetoric surrounding the Delta variant, which is becoming the more dominant strain of those who are being infected here in the U.S. And suffice it to say that the overall trends for infections are going down. We've got, I believe, 350 million people with at least one dose, which encompasses a large part of the population, to such the extent now that we're exporting a lot of these doses, and we're getting younger children vaccinated as well. So again, the infection rates are going down, deaths are going down. Most of the people that we're seeing in hospitals, and unfortunately those who will continue to succumb to the virus, are those who are non-vaccinated. So, just a quick update there. I don't want to get too much into the details. Obviously, we're still in a pandemic, and globally, there's still areas that are struggling with this Delta variant and don't have the vaccination rates that we do here. And I think we've kind of reached a saturation point to some extent on those who are willing to receive the vaccine. And so a lot of folks you talk to now that haven't gotten it are not planning on getting it at some point. Well, a quick check-in on consumer confidence, because it's been very strong. Emerging from the pandemic, we see very strong data points. Here you can see the present employment factor has added a lot to the consumer confidence number, both on present employment as well as future employment. Present business and future business, I think, remains a little bit subdued just because we are continuing to merge. But I do see in a separate chart that tracks data, tracks a survey directly from the National Federation of Independent Business, which is a barometer for small business. This is the conference board data in this chart. But the NFIB data really represents the same positive and upward sloping trend that we've seen consistently here over the last several months. Here's another reason to be confident in things looking ahead. We've talked about this a lot, but this chart from Cornerstone Macro really defines what the opportunity set is insofar as consumer spending expectations are concerned. We can see through the pandemic we had a lot of savings. We've talked about that ad nauseum, but the savings rate and liquid assets amongst the consumer base are really blowing out here. You can see, that dotted line represents a kind of a line of best fit for, a 3 to 4 year time frame, actually predating 2017. But you can see where we are now is 3.5 trillion. It's plus 3.5 trillion over the trend line, which is really phenomenal. And I think it does lay the pavestone for continued strength in consumer spending. And insofar as the equity market doesn't crater, I think that's going to add net wealth to the equation as well, which is going to I think help to bolster things as we head into the latter months of the year. A lot of data on this chart, but it really goes back to the consumer. It goes back to the retail industry, which has struggled to get back on its footing. There's a lot of read through on this, and I thought was really interesting. So on the upper left is the ISI retailer survey, and this is pricing power. So this goes back to inflation. So retailers' expectations of being able to increase prices is going up. And we've seen all of this happen in the commodity side of things, and now we're seeing it on the retail side. So consumers have more to spend, consumers are spending, they're optimistic, and retailers are getting price as a result of that. And so this continues to drive my thinking that we're going to settle in at an inflation rate that's going to be higher than what we've enjoyed over the last several years, but it's not going to be necessarily onerous. And we want to protect against the risk of some kind of outsized shock that we're not expecting. But if you look at this data, you shouldn't be surprised at higher inflation coming down the pike. Now on the upper right-hand side, you see the ISI retailer sales survey. So they're very optimistic. This is very positive. So retailers are expecting higher sales, they're expecting higher prices, that to translate into better profitability. Again, this is a broad swath. So we want to make sure and hope that smaller businesses are going to participate in this as well. And then, going back to the inflation comment, you can see down below, this is the Conference Board's consumer inflation expectation. So this is a survey, and it really helps to define what the consumer expectations are for inflation. So not only are retailers getting it, and they expect to get it, but the consumers are also expecting to pay it as well. Here's some interesting data from Bank of America and some recent research published by them showing daily online retail spending where card is not present as a share of total card spending. And it shows a reasonable decline, which is kind of interesting. So, we had a little spike there when people were doing a lot of online shopping over the holidays. So you see that December 20 spike there where a lot of people were doing online where the card wasn't present. But this gradual decline, I think, is important for this reason. We just saw in the last chart that retailers are exuberant, they're getting prices, their sales expectations are high, and what this chart is telling you is that you're getting more of those retail sales in the store. So retail spending where a card is not present is actually trending down a little bit, and that means that more people are in the stores, that are buying things, that are out and about and physically spending money as opposed to just sitting behind a computer screen. And the same trends are evident in these different categories below. You can see very similar trend lines on the 7-day moving average, but I think a really positive sign from an economic health standpoint that people are getting out and patronizing our businesses. Now we'll switch our attention here to real estate for a second. So these numbers will not surprise any of you if you've been watching these charts of the week for some time. You can see both the Case-Shiller 20-city composite on the upper half of this chart, as well as the National Home Price Index. Both of these are up about 14.5% to 15% year over year, and these are increases that you rarely see, but we have seen them. I mean, it's not unprecedented to have this kind of a rate of gain. You can see that it happened both coming out of the global financial crisis and again in 2012, 2013. So, but we are at a point here, just in terms of the index, that we are kind of in rarefied air, and not to alarm people, but we're at a point that we were at kind of a couple of years before the global financial crisis. I do think the prices are going to moderate. The backdrop here is that we have very low interest rates, and for people with good credit, there's lower mortgage rates, and to some degree, like I said, with people with good credit, there's availability of credit. I do think once interest rates begin to increase, and I think there's a case to be made for that, that it'll take some of the steam off the housing sector. But obviously very strong right now and in a very sustained trend. Here's existing home sales on the left-hand side. And I want to draw your attention really to first to that dotted blue line. And those are the actual sales. And so you can see that this is kind of a diffusion number. So anything below zero represents a negative gain. And these are month over month figures. And so we have been a little soft. Inventory of existing home sales has been very tight. And so that's helped to influence that negative trend here over the last several months. However, if you look at the green solid line, it's pending sales. So, we've exited the school year. We're at a point where people typically exercise mobility and moving to get kids in new schools and things like that. So you've seen a bump. And so I think that we're on the precipice, given kind of this the relatively short-term data set here, but there is a pretty good correlation that now that we see that green line pop positive, I think we're apt to see actual sales numbers turn positive as well. On the right-hand side is the basically a survey of rents. This is from Evercore ISI. So the point here is that with everything rolling over last year, we're at a point now where we're trending higher now, and rents are going up. I think people are settling in. And I think it's symptomatic of an economy that's increasing its mobility. So I would expect that this rent number will continue to trend a little bit higher. Here's a quick check-in on job openings and reasons for people that are citing for job searches are not urgent to them, and kind of an interesting takeaway from this. But on the left-hand side, you can see data from Indeed.com job postings. Again, trending higher. That's the blue line. The black line is job openings in million based on that right-hand scale. You can see they're tracking very close together. So job openings are increasing, and employers are still having a little bit of time filling some of these jobs. Now, if you look at the right-hand side, you can see, of the people that, why is it hard to fill jobs? And people have given several reasons why, and this is broken out between people that have a college degree and those who don't. What's interesting down at the bottom is that the answer is really not these unemployment insurance payments that has often been cited. We've talked about the fact that there's childcare responsibilities and there's still some latent COVID fears, which is interesting as high as it is, but there's a lot of different reasons why people aren't really actively looking right now. But I guess my revelation here is it's really not because of these excess unemployment insurance payments. Continuing along the thread of of labor here, on the left-hand side you see the job quit rate, and so this is a sign of a healthy economy where there's a very robust labor market where you've got folks that are confident enough to quit their jobs. And we're also seeing wage growth too. So the black line represents the employment cost index as it relates to private wages and salaries. You can see that black line is kind of jockeyed around a little bit, but it's on the way up. And the quit rate is really spiked. Which is pretty phenomenal. And so, there's a lot of data points, and one of these salient data points here that I think is worth noting on the right-hand side is that basically the amount of retired as a percent of the population. You can see on this chart, it's a blue line with a dotted black line representing the line of best fit dating back to the global financial crisis. And as you go up and to the right, you get to a point in the pandemic where you see a real spike in the amount of retired folks, and so that's taking people out of the labor pool, and it looks like a permanent shift higher. So you can still see that number is trending higher. Obviously, we've got an aging population, but during the pandemic, we had a spike in those who were, who basically, hung it up and rode off into the sunset. So I do think that having an increased retirement trend or enhanced retirement trend, if you will, over the last year will help wages, and it obviously makes the labor pool a little bit tighter. So hopefully that will allow more of the younger generation to rise up, and we can have a more robust labor market here looking ahead. This is a chart that shows you jobs plentiful and it subtracts jobs hard to get. And so what this tells you right here is that jobs are really plentiful. So, I mean, we just talked about that, so this is no surprise. But here it is in the data. And so we've had various points in time here dating back to 1978 on this time series where jobs have been very plentiful on a relative basis. And clearly, if you look back at the 2000, actually in the great tech bubble bursting, there were a lot of jobs available. And then we've had spikes, at various points in time. And, if it hadn't been for the dislocation of the pandemic, we might have been here anyway. But you can see that on a relative basis, jobs plentiful, less jobs hard to get is really high right now. Again, very positive from a labor overview standpoint, but as we'll see, this has implications. So in this chart, we took basically the jobs plentiful less jobs hard to get, and we reversed it. So we just said, the jobs hard to get less plentiful. And so it gives you kind of an upside down figure, and then you overlay that against the unemployment rate. And so obviously there's a very strong relationship here. And I did this for effect because where we are here at unemployment rate, below 6, I think based on this data right here, that unemployment has an opportunity to go much, much lower. Oh, some quick comments here on the commodity sector and global logistics. A chart that I came across on stockboard asset. Atlantic ports are really delayed, and they're delayed all over the world to some degree, but I thought this chart really stood out to me because, we've talked about the choke points that were developing earlier this year during the first quarter, and those have persisted. So we still haven't worked out those choke points. So there's a lot of data that we've shown you over the last couple of months that shows you, delivery lead times are extended, and those types of things really continue to be at play. And this chart really helps to define that. On the right-hand side, you see the Evercore ISA trucking company sales survey. And so this is basically an expectation or a barometer of what's going on in the overland trucking industry. And you can see that we're more than a standard deviation outside the norm, which is phenomenal. So it's very robust. So demand for overland trucking is high, sales are up, prices are high. The cost of transporting everything has really gone up just because there are a lot of these choke points and a lot of demand out there. Here's something I wanted to show because it is relevant to the global recovery here. And this is basically all of the Asian manufacturing countries together in a purchasing manager index. So what does that mean? It just means, this is basically a manufacturing survey number for all the Asian rim manufacturers, manufacturing countries, if you will. And we've actually had a really robust fall in output, something we haven't seen in over a year, decline in new orders, and as it says here, business confidence dips to a 10-month low. So it's still relevant that even though we have a fairly strong environment here in the States, that overseas it's a little bit more lumpy, and I'm not going to necessarily tie this directly to increased COVID cases in some of these areas that are struggling with the Delta variant, but it is a factor. And we know we've seen a pickup in some countries where vaccination rates are really low, and you've got this new highly contagious and communicable variant. But you can see the manufacturing data is a little bit low. And the other thing I think I would interject in here is just the fact that we do have these supply chain bottlenecks, if you will. And so, there's really, when you're clogged up in the supply chain, a lot of the front end and interim manufacturing is not needed. It slows down until you can kind of work out the kinks in your supply chain. So a lot has been made over Bitcoin and these cryptocurrencies, and I think it's interesting. I've got really a couple of checkpoints in here. I had to blow this chart up a little bit, so it may be slightly fuzzy, but from KFin. But it shows you the year-to-date returns on Bitcoin. You see the black line represents your Coinbase Bitcoin price. And you can see the volatility. That's very evident. We've seen highs and we've seen it come off its lows. And if you look point to point, year to date, what's really interesting for all those people that are excited about investing in cryptocurrencies is that if you overlay this against commodities, which is the orange line, and then the kind of the violet purplish line is the S&P 500, that Bitcoin year to date is just modestly almost laying on top of the S&P 500's performance, and it's actually trailing the performance of commodities. And here's the other piece of that crypto view here, real quick. It's the volatility. So this is not a price gauge. This is just the volatility as tracked by CoinDesk here, and you can see, the S&P 500 in this chart is in the kind of the yellowish amber, if you will, and gold is noted here in red, and then bonds are gray, a little bit harder to see, but you've got Bitcoin and Ethereum here, and these volatilities remain really elevated. So again, I'd say caveat emptor, let the buyer beware that this is the nature of cryptocurrencies right now. There's still a lot of definition that needs to be built around cryptocurrencies and what are they currency? Are they a commodity? Are they an asset? These are still valid and open questions, but we just have seen a lot of volatility in these cryptocurrencies, and we're going to for some time. Getting back into the commodity basket here, I've got a couple things, and then we'll transition over to the equity side. That we've got grains. Again, this is a global grains sub-index to the commodity basket, and grain prices have really spiked, and there's a lot of different reasons for that. We've had an increase in temperatures in various parts of the country, and so this is something we're going to have to monitor because it feeds into grocery prices and meat and everything else, and so we're just going to have to watch this. And here's kind of an expanded view of that. You look for the index for price paid on feed grains, and this is what gets fed to these cohorts on the right: cattle, hogs, and pigs, and milk cows. Input costs, if you will, are going up. And what I think this chart on the right tells you from the Wall Street Journal is pretty interesting. That a lot of the areas that are witnessing really high temperature variances, Pacific Northwest is just one area, but we've seen spikes in temperatures in many parts of the country, and it's impacting the agricultural sector in a pretty big way. So we've got higher input costs, and then we've got a percent of U.S. livestock that are really in tough drought conditions too, and it's making for the potential for kind of a food price spike here in the U.S. as we head into the second half of the year. This is something that we've shown in the past, but this is a more of a global number. And so we just talked about what's going on in the U.S., but clearly there is an issue globally with food prices. And when you think about the percent of the global population that is, that is in a poverty type situation where a really outsized percent of their um, of their national income and personal income is dedicated just to the essential food items, that this is a real big impact. And you could see here that it's been trading or it's been trending in a range rather for a number of years, but it's really spiked here lately. And what's going on in the U.S. is kind of a net exporter of beef and some of these other agricultural commodities, it is probably going to continue to drive this number a little bit higher. All right, so here is the basically the gold index. This is the S&P Goldman Sachs Commodity Index, Gold Spot Index, or at least the gold component of which. And you can see that gold here, as we look at this on a month-to-date or monthly trailing number, you can see the impact of gold prices here in over the last 6 months. And we've really seen post-pandemic kind of a transition away. Obviously, we've got higher interest rates, which can put pressure on gold. And I think if we see further kind of moves in the dollar, and we'll just have to see how that plays out, with this increased rhetoric about tapering asset purchases by the Federal Reserve and what that's going to do to interest rates. What happens to interest rates will obviously have have an influence on what happens to the dollar, and then in turn it will have an impact on gold prices. But we can see here that year to date, the gold has really struggled against other baskets. But this, looking at gold in isolation here, it's clear to see that volatility so far in 2021. Here's a quick look on oil. Important to look at oil because we've got crude inventories that are being drawn down. More people are on the road. We have greater gasoline uses. And then you can see down here on the right also that we have greater than expectation in draws. So this all goes into this notion that we're going to continue to see some support for oil prices, which means we're going to see some support for the commodity basket overall, which I think is good from an investment standpoint. I think commodities, and you'll see the correlation between commodities and equities in a second, that are increasing, but this will continue, I think, to help bolster equity price performance because of things like this. The economy is opening up, and gasoline usage and stores of crude oil are going down. All right, and here's that chart of the correlation between the S&P 500 and the Goldman Sachs Commodity Index, the GSCI. And what's really interesting here is, typically commodities have a very low, and as you can see here, sometimes a negative correlation. So this is good from a risk management standpoint. So you include commodities because their return profile doesn't really link up or sync up with equities. But what we've seen here lately is that on a 3-year and a 10-year trailing basis, that the correlations have really picked up. And that means that, that the commodities and stocks are tending to move in the same direction, more so than they have certainly a decade ago. And so while in the last slide I said, commodity exposure I think should help bolster equity returns, and I think I would label that as, commodity returns should be complementary, and in some cases supplementary to equity price performance, but that's not necessarily what we want all the time. We want some diversification that will help mitigate our risk. And so that's something from a portfolio management standpoint that we're going to have to take a hard look at to see, what do we want to use commodities for or in our portfolio allocations. Here's a quick check-in on the price performance, year-to-date return. So obviously we just completed the second quarter, and you can see, not too surprising with what we showed you on the energy chart, that energy has performed really well. Value continues to perform well. Small caps are doing well. Small and mid caps both are doing well. So the S&P 500, both small and mid caps are outperforming the S&P 500. And you can see growth, while it's still positive, is actually lagged for some degree. And you see volatility down tremendously. We just don't have volatility in the equity market right now, which is really, I think, a little bizarre. It's welcome, but I don't want folks to get too comfortable with it. And then if you look across the global spectrum, as we've kind of highlighted in our market minutes, I mean, we've actually had decent performance overseas, and we have had a rate of gain in the equity market for the first 6 months of this year that has actually exceeded what we would normally expect, almost, in some cases double what we expect over the course of a full year. So it's hard to think that we can get like another half a year of growth in the U.S. that we did in the first half. But when we talk about U.S. returns, we kind of lose sight of the fact that globally returns are actually tracking pretty well despite the emergence of this Delta variant, despite the fact that vaccination rates are not as robust in some areas. But there is validity in this argument that we've got this global recovery. It may not be as completely synchronized as we might have thought it was going to be, several months ago, but it is happening, and it's translating into these international markets, which frankly have a lot more value from a price to earnings standpoint than the U.S. Markets do. And then taking a quick look here at the year-to-date figures, again, 6 months worth of data. What we see here in the return attribution for the S&P 500 is actually an abject reversal of what we saw last year. Last year, we saw multiples expand. A lot of it had to do with the concentration of stocks, these technology stocks, Google and Facebook, et cetera, that really performed well. And so all these multiples expanded. And then, we had earnings contraction last year because of the pandemic. This year, it's really reversed, and we're getting a huge boost out of earnings. And at the same time, because earnings are growing faster than market prices are, even though market prices are going up, we've actually had multiple contraction, which is why you see that reversal in that 2021 year to date. But we're going to get another strong return, or at least we have over the first 6 months, and a lot of it, by virtue of this chart here, has had to do with earnings. Here's a quick look on the full S&P 500, which is noted in black, which is obviously very strong. And then that's judged against the equal weight, and that's in blue. So we know that the S&P 500 is a capitalization weighted index, which means that the largest capitalization firms in the index have an outsized influence on what the index value is. And whereas the equal weight is just what it is. It takes essentially more or less the 500 stocks that are in the S&P 500 and just divides them equally. And you can see that from an equal weight standpoint, the smaller components, smaller members from a cap standpoint in the S&P 500 are really lagging, and lagging to a reasonable degree. And this is something that we've seen consistently, I think over the last month or so. And it'll be interesting to watch how these smaller companies within the index perform coming into the second quarter earnings reporting season. Well, here's something that I kind of talk about, but now I have a chart to show people, and there's a lot of big negative numbers on this chart, but as we enter this second year of this bull market. Again, you go back to 2020, we had a really quick bear market, and then we resumed a new bull market, and we're in this year two of that. And I don't want to scare people, but I just want to say, I just mentioned that we've seen really abnormally low volatility, and it's just normal during year two, during any year, frankly, to have little course corrections and pullbacks. Correction would be technically 10% decline. And you can see here that we've had periods in year two of bull markets where we've had some decent declines. And so this is why we're adding portfolio insurance to our portfolios and adding non-correlated assets to kind of help protect our downside. And it's normal, it's expected. And it's a natural thing that is really not to be feared, but just to be prepared for. All right, well, here is something from BCA research, and this gives me a lot of hope actually, because what we see at the top hand side, again, we've talked about profits being really, really strong. Pre-tax profits we know are moving higher. And BCA has a model that says, based on real GDP, where these rates are going to go. Excuse me. And on the bottom side, we've got basically this ratio, if you will. If you're above that zero line, that means that capital spending exceeds your retained earnings. That's where you're spending more than you're actually, I guess, reserving in some sense after your earnings. Now on the bottom, which is where we are now, is that retained earnings are greater than capital spending. And we know capital spending intentions are increasing. And we know capital spending itself is increasing a little bit. But what's happening here is we're growing earnings at such a fast clip that it's now exceeding the rate of spend that companies are doing for the companies are investing in their own infrastructure, et cetera. And so I think what this tells me is that there's a lot of horsepower available for companies to ratchet up their spending because earnings are so good and they're putting a lot of money away. And I would certainly expect to see this as the U.S. kind of doubles down on its, I'd say, its efforts to be more globally competitive coming out of this pandemic, particularly in 2022. I would definitely expect to see increased capital spending here in the States. A couple of quick check-ins on data that we've shown you in the past. First, I'll hit the one on the right. No surprise, share buybacks have bounced back in a big way. Again, lots of profits out there. Companies, a lot of companies pulled back their dividends last year, and now they've resumed those, and now they actually have more seed corn because profits are up, and this number is going to continue to go higher. Another interesting development, and this may be a little symptomatic of just the robust market that we have for not only new initial public offerings, but also follow-on public offerings. And this chart from Bloomberg is really interesting because the kind of this pink line represents the number of unprofitable firms that are going to market and raising money. Again, these are not profitable companies that are going out and raising money. Again, we're in an easy money environment. Rates are low. There's a lot of liquidity sloshing around. You can see in the black bars that you've got profitable firms that are doing, follow-on offerings, selling more shares in the public markets. But you're really seeing a huge spike in unprofitable companies doing the same thing, which it doesn't scare me a little bit right now. But you've got a lot of money trying to chase good ideas, and when you start to worry about recession, that's when you start to see good money chasing bad deals. And I don't know that we're there yet. And in some of these cases, frankly, these unprofitable firms are raising money so they can invest in their business to help them become profitable, and oftentimes they do that. But again, I just thought that it was really interesting given where we were last year, where we are this year, the state of liquidity and the state of consumer confidence, investor liquidity, investor net worth, all of these things playing into these two figures here. All right, yield curve. We've got three different charts here. The first one represents the U.S. These are all U.S. Treasuries. So it's the 2 to 5 year Treasury spread. And then the middle one is the 2-year to the 10-year Treasury spread. And then the one down at the bottom is the 2-year to 30-year spread. And this time series goes back to 1985. And I think it's really, it illustrates this point that historically, and this has actually been, as it says at the top, it's been fairly consistent in this peak here, in these peaks in prior cycles, and it suggests that we have a long way to go, basically in spreads and in yield curve becoming steeper. And we know that inflation is out there. I do believe we're going to have higher inflation next year than we had at the beginning of this year before we saw the commodity price spike. Again, not a bad thing, normal during a growth phase, and certainly at the early part of a new economic cycle. But I do think that we're going to have higher, longer-term rates. And so, especially when you think about the 10-year rates moving higher, I think that's, the Federal Reserve is going to adjust their interest rates at some point. We already see inflation expectations being built in. This will have an influence on the mortgage market. It'll have influence on, a lot of borrowing capacity, people wanting to, to expand. But it also will help savers. And I think that's, for me, is a really good takeaway from this, is that there's upside in these spreads moving higher, and that's a good thing for savers. All right, last slide today is something that's been in the news a lot lately, and these are ransomware attacks, and in these different areas, education, government, and healthcare. The more I read, the more I'm convinced that this is going to be something that we're going to be dealing with for a long time. Knock on wood, it's not happening to your business if you're a business owner. But this is something that we have internally really spent time and money on to try to guard against this. We've seen a large spike in these rather notable ransomware attacks, and probably the one that got the most headlines was the Colonial Pipeline shutdown. And but that's certainly not the only one. And so this is clearly something that we're going to have to wrestle with for quite some time. And you can see the trend lines here are moving much higher in that regard. Well, that will do it for the chart pack this week. I hope, again, that you had a wonderful July 4th holiday. On behalf of my colleagues at BKA Wealth, I hope you have a safe week, a productive week, and we look forward to seeing you again soon. Take care.